So how much will you save by utilizing a CRNA loan as compared to a conventional loan and avoiding mortgage insurance? You know, there's a lot of misinformation about mortgage insurance out there. So let me tell you a few things about mortgage insurance. First of all, as I had mentioned in a previous video, mortgage insurance is generally not tax deductible at the income brackets of CRNA. Mortgage insurance generally costs between 0.5 and 1.5% per year. So if you have a $400,000 loan, that's going to cost you 0.5 to 1.5%. So you're talking about somewhere in the neighborhood of $2,000 to $6,000 per year for that mortgage insurance, not tax deductible. So certainly it drives up the cost of the loan. But what is really not understood about mortgage insurance is how you get mortgage insurance off. Now, by law, when the loan amortizes to a 78% loan to value, the servicer has to drop that mortgage insurance off. That's law. If the home appreciates and you've paid down the loan, so it's not the normal amortization, then you can go in, get the home appraised, can prove or document that you have at least the 20% in equity, and you can get your mortgage insurance dropped. Now, many clients have told me that is an incredibly onerous process. They've given up on the process because it was so onerous, and they just decided to refinance. So depending on the servicer of your loan, that may be much more difficult than what you're imagining on the onset. And the fact is, if you're doing 5% down on a conventional loan, in most cases your mortgage insurance isn't going to drop off. You're not going to hit that 78% loan to value range until you're about 11 years into your home. So if you were to pay a 4% interest rate plus 1% in mortgage insurance, for the first 11 years, you've got a total cost greater than 5%. And I say greater than 5% because remember that mortgage insurance isn't tax deductible. When you compare that to a CRNA loan, where you'd be at maybe 4.2 or 4.3 in today's world, you're saving 0.6, 0.7, 0.8% on a $400,000 loan. It's about $3,000 a year over 11 years. So you could easily save $30,000, $35,000, $40,000 by avoiding mortgage insurance. Now, if you were in the home for 30 years, which virtually none of our clients are, but if you were, then potentially it would be better to go with an option with mortgage insurance. But from our history, from what we see clients' patterns being, that within 5 to 7 years, almost in every case, our clients' lives have changed enough, meaning income's gone up, debt's gone down, family size has expanded, relationships change. There's enough change over 5 to 7 years that almost in every case, there is either a move or a refinance because they decide, hey, this is where we want to be for life, and we've paid down a lot of these student loans. Now let's go to a 15-year loan and get this thing paid off quick. So that's a little bit of information about mortgage insurance. I'm sure you have questions. We'd be honored to help you and be happy to field any of your questions. We invite you to call or email us, and we're looking forward to hearing from you. Take care.